Good afternoon, everyone. My apologies for this slight delay. If I might just ask, we were having a little technical issue in terms of sound. So if people can't hear me, if they would be able to pop something into the chat quickly, just to let me know, because we were just a little bit concerned that the audio was not working, but I do apologize for that. If I don't see anything in the chat, I'll assume that it's all working well, but please feel free to pop something in. So with that said, I'd like to introduce myself and say I'm Craig Evans, Head of Economic Policy at the ABA, and I'd like to thank you all for joining us this afternoon for our ABA Economics webinar. And this session is open to all ABA members, associate members in our broader network, and we're delighted to have such a strong turnout for this final economics webinar of the year. We commence our webinar today by acknowledging the traditional owners of the lands on which we meet, and I pay my respects to their elders past and present. For us at the ABA, we are located on the traditional lands of the Gadigal people of the Eora Nation. Today, we are very fortunate to be joined by one of Australia's most respected economics voices, Stephen Halmarick, Principal and Chief Economist at Economics Unchained. Many of you will know Stephen from his previous role as Chief Economist and Head of Global Economic and Markets Research at Commonwealth Bank. Stephen pioneered the use of internally generated data at CommBank, leading to the development of the Housing Spending Insights Research Project, and also initiated the Sustainable Economics Research Strategy at CommBank. Under his leadership, the CommBank economics team earned top rankings in multiple categories for many years, including in the 2024 Peter Lee Institutional and Corporate Client Surveys. In May 2025, Stephen established his own economics consulting business, Economics Unchained, which provides economic presentation, consulting, advisory, and research services. So his insights have long helped shape economic understanding across the financial services sector, and we're delighted to say he'll be joining us today to unpack the key macroeconomic developments that define 2025 and share his expert outlook for 2026 and beyond, including the forces he believes will shape the global and Australian economies over the next decade. Before we begin, there will hopefully be an opportunity following the panel discussion to ask questions. Please feel free to send through any questions that you may have during the discussion by using the Q&A tab, which can be found at the top of your screen. But now I'm happy to throw to Stephen.
Well, good afternoon, everybody. Thank you for that introduction, Craig. It's a great pleasure to be talking to the Australian Bankers Association today. As I think many people on the call probably have heard me speak in the past, or certainly know me from my time as Chief Economist of Commonwealth Bank. I'm now running my own economics consulting group, Economics Unchained, and really enjoying this phase of my career. If anybody on the line or any of the banks on the line wanted to reach out to me, you can do so on LinkedIn, or I'm happy to provide you with my email address. But now we're going to get into the discussion on the economy. We're going to start with an overview of the global economy, some of the key themes that are impacting us here in Australia and around the world, and then we'll zero in to talk a bit more specifically about what's happening here in Australia. Obviously, a fair bit going on in the last 48 hours or 24 hours in terms of monetary policy. So let's start with the world. So I think it's really important to recognise right up front that the global economy has shown a fair bit of resilience this year. More so than many economists, including myself, thought it might. I look at the forecast from the IMF. They're forecasting a growth this year of 3.2%. That's down marginally from last year of 3.3%, but it's actually quite a bit. That forecast is quite a bit stronger than the first forecast made earlier in the year. And the IMF did a round of forecasts pretty much exactly when President Trump announced the first lot of tariffs. So some resilience in the global economy. But the expectation still is that 3.2%, that's still relatively soft historically, and next year a little bit softer at 3.1%. So some resilience in the global economy, but certainly a bit softer growth than we got used to pre-pandemic, and some, I think, downside risk, particularly in the US. Now, talking about tariffs, I never thought with almost 40 years of being an economist here in Australia, I'd have to talk so much about things like tariffs, or indeed just talk about the President of the United States all the time. But here we are. So looking at some of the, I think, really solid independent information on what's happening with the tariffs here, I've got the Budget Lab from Yale University. The effective tariff rate as at the end of October is around 17%. But I think it's really clear, and I've seen some good research on this in recent days, that the incidence of the tariffs falls ultimately. I think will fall on the US consumer. The tariff is paid by the importing company. I would imagine everybody online is aware of that. It's not paid by China or Vietnam or Brazil or Australia or wherever the goods are coming from. It's paid by the importing company in the US, and that's where the tax falls. I think of it as a GST or a VAT on imports only. So it's a tax on the consumer. And of course, the US companies that are importing these products then need to decide, what do they do with the extra costs? Do they just take it on their margin? Do they pass it through to consumers? Or do they ask the seller, the exporter, to reduce prices a bit, or some combination of all the above? So I've seen some research recently that says of the current inflation rate in the US, which is 3%, 0.7% of that is affected the tariffs. So put that another way, the headline CPI would be 2.3% instead of 3% with the tariffs. So there's some research that's beginning to come through. So I don't think the tariffs are going to alter the US trade position that much. I don't think the tariffs are going to, herald a renaissance of the US manufacturing sector. I don't think they're going to change much in terms of the industrial landscape of the US. I mean, the way I think about it, if you're a chair or a CFO or a CEO of a major US company, and you're trying to make the decision of whether to invest millions of dollars building a new factory to compete against what you used to buy from overseas or what others are buying from overseas, if the only reason you're competitive is that your competition is taxed through the tariff, then I don't think that's a good reason to make the decision to spend millions of dollars, because you don't know what the tariff's going to be next week or next year or 2028 or 2029, when at least we think Donald Trump won't be president anymore. So I think that uncertainty is certainly going to be a weight on the US economy. Now, if tariffs are not very good at changing corporate behavior or industrial investment or trade balances, what are they good for? Well, they actually are pretty good at raising revenue. And we can see some of these revenue numbers beginning to come through to the US budget. And so one estimate from what's called the Tax Foundation is that the tariffs will raise somewhere between 2.5 and 3 trillion US dollars over the next 10 years, assuming they're in place for that time. And that is not quite, but almost the extra cost to the budget from the tax cuts contained in the One Big Beautiful Bill, so the OBBB Act, which is roughly 3.4 trillion US dollars over the next 10 years. So there's some offset there in terms of the revenue raised by the tariffs is going to help fill the hole from the One Big Beautiful Bill. But I think it is worth pointing out that one of the reasons I think that Donald Trump was elected was there's a large number of people in the US who feel like the globalization, the global system has not worked for them for the last 10, 20, 30, 40 years. And we've seen this big widening in wealth disparity in the US. So they've voted for a change agent in Donald Trump. So I kind of understand the reasons why people might want to do that. But I think the bottom line is that policies that have been implemented so far this year, the tariffs and the One Big Beautiful Bill, will widen the wealth disparity in the US. It'll make it worse because the tax cuts are for higher income earners and corporates, and the tax increases, the tariffs, I think will fall mostly on low to middle income earners. So it'll be interesting to see how that wealth disparity plays out in opinion polls, and then of course the midterms in November next year, and the presidential election in 2028. Now, talking about inflation, we of course had been seeing some moderation in global inflation, certainly from the peak during the COVID period. The exception there in recent months is the US. As I mentioned, the US headline inflation rate is back up to 3%, having been as low as 2.3% in April. And the research I've seen suggests that the tariffs are responsible for 0.7 percentage points in that increase. But other countries have seen moderation in inflation. And of course, that's allowed central banks to start lowering interest rates. So we've seen a pretty significant cut in interest rates across many countries there. There's just a couple of examples. The obvious exception being Japan, where rates have gone up a little bit. And of course, the Fed had stalled on its rate increases until September this year. And we've got the rate cut in September, and of course, the follow-up rate cut just last week. Now, the Fed dots do include one more rate cut this year and another one in early 2026. But of course, Fed Chair Powell threw a little bit of cold water on the expectation of a December rate cut at last week's press conference. So clearly we'll have to see how the data pans out. Although, of course, we're not getting much data at the moment, given the government shutdown. And in fact, the only numbers of significance that have come out has been the CPI, because that was needed for some contractual arrangements. So that was deemed as essential. All the other numbers not deemed as essential at this point in time. So the longer the shutdown goes on, the worse it is for our understanding of what's actually happening in the US economy. So that may cause the Fed to just pause in December and await the shutdown ending. And we're now, as I'm sure many people know, entering the longest shutdown in the history of the US. So it's pretty significant. So away from things like monetary policy and inflation, I still think the other key factor flowing through the global economy is climate change policy. Now, clearly this has met some resistance in the US with the new administration. But if you look at data from the International Energy Agency, which is the chart on the left there, that is measures of the amount of investment happening in the climate change policy space, particularly the energy investment. And I think it's pretty clear that the standout from that chart on the left is the big increase in renewables spending over the last few years. Now, the International Energy Agency estimates that global capital spending this year on energy will be $3.3 trillion US. So a big change from 2015, it was about $2.5 trillion, and a flip there in the amount of money being spent on clean energy versus fossil fuels. So certainly money is moving in the right direction. My personal view is we need to really continue this journey to get us to net zero carbon by 2050. One of the things I have done since I left Commonwealth Bank at the start of the year was a course on leadership and sustainability through the Cambridge Institute of Sustainable Leadership. Some really great information gained through there that really reinforces in my mind the need to create every unit of GDP with less carbon. And I think that's the way the world's heading. But it will be expensive. The International Energy Agency estimate of 3.3 trillion is that we're going to have to spend around about that much money, the world, every year to 2050. So it's a huge capital investment program. That's both private sector and public sector. So it's going to cost a lot of money, but I think we need to do it to ensure some sustainability in the global climate system. Now, here in Australia, much debate even today, yesterday, particularly amongst the coalition on the path forward. This is a chart from my former colleagues in the Commonwealth Bank Sustainable Economics team. We can see that as of now, we are tracking inside the government's carbon reduction targets, but the pace of decline is slowing. And on the current trajectory, we're going to miss the 2030 and the 2035 target. But to my mind, that's not such a bad thing or a huge miss. I think if the trajectory stays generally in the right direction, then the pace can miss a few years here and there. But as long as we're traveling in the right directions in terms of the journey of, as I mentioned, creating every unit of GDP with less carbon. Now, of course, recently the US and Australia have signed a rare earths deal. Timing was pretty good for the first meeting with Prime Minister Albanese and President Trump. Since then, you may have seen that the G7, led by Canada, have signed an agreement to work together on rare earths as well, really trying to lessen the role played by China in the global supply chain for rare earths, which currently they have 70% of the deposits and 90% of the refining. So Australia's 5% is relatively small, but is going to be pretty critical over the years to come. So I think that was a very welcome development for Australia be having a larger role in the global supply chain of these critical metals and minerals, and certainly welcome the extra US investment that's going to come our way. Okay, so that's the global situation. Let's zero in a little bit more on Australia. Now, the most recent national accounts is the June quarter, so they're looking pretty dated now. The September quarter numbers will be out in early December, in about 4 weeks' time. But those June quarter GDP numbers did show an acceleration in growth around middle of the year. So the quarterly growth rate picked up from 0.3 at the start of the year to 0.6 in the June quarter, and the annual growth rate accelerated to 1.8%. So you can see on that chart there, that's a nice pickup from the very low levels we saw in 2024, where growth was only about 1%. So a nice acceleration, but still quite a bit lower than our long-run average, which is closer to 2.75%. But I think one of the positives in those national accounts was that the main contribution to growth shifted from the public sector to private sector, to household consumer spending, away from government, both Commonwealth and state spending. So a bit of a changing of the guard there. And I think the rate cuts that we had at the start of the year, February and May, certainly helped there, as well as I'll show in a moment a nice pickup in real household disposable income. Now, interesting to see in yesterday's statement of monetary policy, the Reserve Bank raised its forecast for December this year GDP to 2%. Previously it's 1.7, but as I mentioned, at the middle of the year we were 1.8, so they had to kind of bump up their end of year forecast. But now that the RBA is projecting, or assuming, I should say, a shallower interest rate profile, so less cuts, the Reserve Bank SA actually lowered their 2026 growth forecast to 1.9% from 2.1%, and 2027 is expected to be 2%. So really not much different to where we are right now. So a bit of a flatlining in the pace of growth over the next couple of years is what's in store. Now, one of the big areas of discussion in Australia has been population growth rate. That's a little bit of consternation amongst some people that the growth rate had accelerated too much post-COVID. But I think it was really important to keep in mind, well, to put into context the big surge in population growth in 2023 and 2024, put that in context with the COVID years and what happened pre-COVID. So to put some numbers around that, pre-COVID, the net migration into Australia was about 235,000 people per year. And then and that's the red part of the chart on the left. You can see through the COVID years that actually that went slightly negative. So slightly more Australians left and new people arrived. And then in 2023, there was this huge surge, and the population net migration increase was over 600,000 and then over 400,000 in 2024. So you hear this comment sometimes, more than 1 million people in 2 years. Well, that's true. But the previous 2 years, it was slightly negative. So, it's definitely a bit of a double up to catch up strategy post the pandemic. And we can see from the chart on the right, the biggest increase was in international students, so net temporary student visas coming in. So the universities really were very active in bringing in lots of new students. So if we average out 23, 24 with 21, 22, we're averaging a little bit higher than the 235,000 pre-COVID, but not that much higher. And we can see from the chart that we're already well past the peak. So the population growth rate is moderating. It's back down to 1.6% as at the start of this year. For next year and 2027, they expect it to be about 1.25%. So I think we'll end up at about maybe 250, 260,000 net migration every year for the next couple of years. So that's a bit higher than it was pre-COVID, but it's nothing like the surge we saw in 2023 and 2024. So I did mention this increase in real household disposable income that's been coming through, and we can see that pretty clearly in this chart here. So above the line, the blue bar and the orange bar is income coming in, nominal dollars coming into households. And you can see that it's growing around 8 to 10%. So quite a significant increase in nominal labour income, so wages and salaries. We know the labour market's been strong, as well as some non-labour income, government payments. But what we do know is that for a long period, 23 and 24, that increase in nominal dollars income was more than offset by a sharp increase in prices, inflation, an increase in taxes, bracket creep, and an increase in interest rates. So the combination of those three things sucked all that nominal income away from households, and many households found their real household disposable income declining year on year for quite a number of quarters in a row. So I think that really is a good definition of the affordability crisis in Australia. But we can see from the chart that actually things have improved. Of course, inflation has moderated. We had some tax cuts, and interest rates have come down. So now real household disposable income is rising, and that's been reflected in this strength that's come into the consumer. I'll talk a little bit about this later on, but I do think now that the interest rate cutting profile from the Reserve Bank is going to be more modest than many people thought it was going to be, that big run up in consumer spending might wane a bit. Indeed, if we look at this chart here from the yesterday's statement on monetary policy, we can see in the June quarter 25, quite a significant increase in total household consumption relative to the previous quarters. I think there's some one-off factors in there. There was a bit of a bounce back in Queensland after the big dramatic weather events earlier in the year. There were some pretty big sporting events like the British and Irish Lions rugby tour around about that time, State of Origin, things like that. So I think when we get the September quarter national accounts in about a month's time, we'll see September quarter 25 consumer spending softer than that big increase in June. And then into next year, maybe a little bit more softness given now the next interest rate cut seems to be at least 6 months away. On the labour market, as I'm sure many people are aware, the unemployment rate had been pretty steady, just kind of creeping up quite slowly for over a couple of years. And then we got the September print, which saw this big jump in the unemployment rate to 4.5%. On the back of, it must be said, an increase in the participation rate to a record high, or equal record high, 67%. So even though there was some employment growth, the labour force just grew stronger. Now, Michelle Bullock, the Reserve Bank governor, has made the point, which I agree with, the employment numbers are pretty volatile month to month, so we'll see. But I do think we're going to continue to see some waning of the strength in the labour market, a moderation in employment growth. And if we look at the Reserve Bank's forecast from yesterday, I think the unemployment rate forecast is the one where there is the most risk of the Reserve Bank missing their forecast. They're now forecasting the unemployment rate to be 4.4% all the way out to the end of 2027. And the previous forecast was 4.3%, so they barely changed the forecast. I think there's a risk that the unemployment rate is going to be higher than the Reserve Bank's forecast over the next 12 to 18 months. Of course, another area in the Australian economy where there's always big discussion is productivity. Anyone who's been around as long as me will know that this has been a big point of discussion for many, many years. We had the Ken Henry tax review back in 2015, I believe. I'm going to say if we had done some of that at that time, things probably would have been better off. But there's a long list of things that governments could do to improve productivity. Of course, the Productivity Commission has got some reports pending after the roundtable discussion of a few weeks back. I've got to say, in terms of how many of these things on the list are going to get done over the next couple of years, I would say I'm hopeful but not optimistic. So maybe to really get this inflation number down and under control, to get interest rates lower, we're going to need some more productivity. So I shouldn't say not maybe, definitely we're going to need some more productivity. I am reminded that many people say, productivity is not something the government does to the economy. They don't give productivity to the corporate sector, to the private sector, but certainly they can help with the environment in which the private sector is operating in. So let's hope we do get some of these big reforms done over the next year or two. As I said, hopeful, not particularly optimistic. Now, one area where we definitely are seeing some improvement is in building approvals. So the numbers in the monthly building approvals data are quite volatile. In September, they were up 12% after a couple of months of weakness. But as you can see from this chart, clearly the biggest area of improvement is in apartments, whereas single dwelling houses are pretty flat. So we're currently running, as of September, at an annualized rate of about 192,000 new dwelling approvals per year. So that's definitely a pickup from the lows. We got down to about 150,000, but it's still well short of the 240,000 per year in the government's housing accord. So the housing accord has a target of 1.2 million new dwellings over 5 years. That's 240,000 per year. As I said, 192,000 well below that. And I speak to a lot of people in the construction sector, and I have to say, nobody thinks we're going to hit 240,000 per year for 5 years in a row. So we're definitely improving, but I think we're going to remain quite short of that gap between demand and supply. And as everybody who's done Economics 101 knows, when demand exceeds supply, there's only one thing that can happen to the price, and that is that it goes up. And looking at the totality data for the month of October, which came out a couple of days ago, a really significant acceleration in house price growth in October. So up 1.1% for the month. That was the largest monthly gain for quite a long time. And the annual rate is 6.1% across the country. Some really big increases in what used to be, well, we could call those still the more affordable cities, so Darwin, but also Brisbane, Adelaide, Perth, you can see really leading the charge, whereas Sydney, Melbourne and Canberra and indeed Hobart are relatively quite soft. Now, the August rate cut is still going to flow through to the data. And as I said, we've got this situation where demand continues to exceed supply. So for all of 2025, I'd expect to see prices up about 7% and probably up another 6%, about 5% in 2026. So while the gap is beginning to close between demand and supply, it's still positive, and I still think prices will be rising next year. So business investment has seen a bit of a pickup in the non-mining sector, but mining capex has been pretty flat. So we definitely need to see a pickup in private sector capex to support economic growth. As I talked about at the start, the rare earths deal I think will help, but we need to see these improvements in productivity and business investment to really drive the next leg of growth through the economy. Now, coming to the inflation numbers, pick your adjective. Was the third quarter CPI shocking, or was it terrible, or was it shockingly terrible? I was at the dinner that Michelle Bullock spoke at last Monday for the Australian Business Economist, and she was asked, what would be a material miss on the Reserve Bank's forecast, bearing in mind the Reserve Bank was forecasting trim mean of 0.6% for the quarter, and she said, oh well, she said, an increase 0.3% or more than their forecast, so 0.9 would be a material miss. That's a 50% error. Anyway, it came in at 1% for the quarter for the trim mean, so really very, very high. There was not very many people forecasting a number that high. You can see in the chart there that both the headline rate now at 3.2% and the trim mean at 3% basically offset all of the gain made in reducing inflation in the first half of the year. So we had seen inflation moderating into the target through this first half of 2025, and boom, back up to the top of the target for the trim mean and above for the headline. So really disappointing, and clearly that led to the rates on hold decision yesterday. So no economists, including myself, is forecasting a rate cut yesterday. So the big question now is, are they done cutting rates, or might they be able to resume? So I know there's quite a few people thinking, well, actually they could be done cutting rates now, and maybe the next move is up in 2027. And markets never like factoring in no change in the cash rate for an extended period of time. They're either going to factor in cuts or hikes. So my view is that we should expect a resumption or another rate cut, but not likely until May next year, so about 6 months away. And I think the reason I say that is I think it'll take that length of time before the Reserve Bank has any confidence that the moderation in inflation has resumed. So as I'm sure many people know, as of this month, we're going to start getting monthly the CPI reading, so the full CPI every month, which will be excellent to receive. Although having said that, the seasonally adjusted trimmed mean number will not be the full seasonal adjustment for another 18 months or so. So the Reserve Bank has said they're still going to rely on the quarterly trim mean annual rate for their best guide on where inflation is heading. So by May next year, we'll have the full suite of the monthly CPI numbers, as well as that quarterly trimmed mean. And if they show some downward track, then that should help the RBA get to the decision to cut rates. Now, that also I think will rely on or require the unemployment rate moving higher than the Reserve Bank's forecast, as I've just discussed. So we're in for about 6 months of no change in monetary policy. We've got a December meeting, early December, then an early February meeting. I think they'll pass with no change, and then a cut at the May 2026 meeting. Now, one thing that the Reserve Bank governor talked about yesterday, or was asked about, and Chris Kent from the Reserve Bank gave a speech on a little while ago, was the neutral cash rate. And so this is a chart from the speech from Chris Kent a little while ago. And the implication there is that the neutral cash rate's about 3%. And this is up from the low of 2% seen through COVID, but certainly lower than for the last 20 years or so. So my gut feel is the neutral cash rate was also around about 3%. So previously I had been thinking the RBA would get down to neutral with the cash rate. And now I'm saying maybe 3.35%. So this is something the Reserve Bank governor said that they keep an eye on, but the closer you get to it, the harder it is to know exactly where it is. And, we'll see how the Reserve Bank goes in coming quarters, estimating that neutral cash rate. Now, just before I finish, here's the key takeaways. Tariffs are bad news. The global economy is showing some resilience. I think we need to really focus continued on that renewable energy investment. The economy has shown a bit of momentum, transition from government spending to private consumption is great, but employment looks like it's softening a bit. The housing market's very strong. Business investment and productivity need to improve. Inflation had been moderating. Now that process seems to have reversed, or at least stalled. So one more rate cut is my view, but not until May next year. Now, most of that's been about the next, 12 to 18 months. Just to give some longer term views, what I call the 6Ds, the main factors I think that'll dominate for the next decade or so. Demographics, decarbonisation, defence spending, government debt, decoupling from China, and AI. So I'm not going to go into those into detail now. So I've got some time for questions. So Craig, I'm having trouble hearing you. So hopefully we can type in the questions.
Well, thank you, Stephen. I'll just double check to see whether you can hear me not. Doesn't seem that you can. All right. Well, I might pop something in the chat for a question at the moment. And I also strongly encourage members, if they have any questions that they would like to, please pop them in the Q&A and we will transfer them across to the chat. So first of all, I want to thank Stephen for the question. What I might do is just pop in a question that I did have into the chat, and perhaps Stephen can see it and have a look at it, and he might have the opportunity to have a chat.
Okay, yeah, so Nauru, and again, the governor was asked about this last Monday night. So I think we're pretty much close to the Nauru. Here we are. Unemployment rate low fours. It's, again, 4.5 in September, a bit of a pickup. I think the neutral cash rate is a bit lower than where we are now, so close to 3. But inflation had been moderating. Growth was pretty soft. The unemployment rate's just moving up pretty slowly. So I think it's hard to be really precise, but I think for both the neutral rate and a neutral interest rate and the Nauru, we're pretty close to where they are right now, both lower than they would have been, certainly a decade or so ago. Yes. So, I think historically, and compared to, similar countries, Australians put a lot more investment, a lot more capital into housing than other similar economies. And, perhaps less going into private sector corporates to CapEx, except for the mining boom we had a decade or so ago. So that gives us a very different structure in the economy here, makes us much more sensitive, I think, to the short end rates in the economy, and I think that has had a negative impact on productivity. But I can't see that changing anytime soon, right? We can see from the most recent housing numbers, money's still coming in to housing, clearly for both people to live in, but also as an investment vehicle. So is there a positive scenario for the economy? Well, yeah. I mean, people ask me, given all the noise, how is Australia going? And the answer is actually it's not too bad. Growth's 2%, give or take. The unemployment rate's a lot lower than historically has been the case. Inflation, did pick up in in September quarter, but still not too bad. So things aren't too bad. They could be a lot better, but they could certainly be a lot worse. So I think the upside is, where's the natural advantages for Australia? Well, resources, but I think Australia will have a significant role to play in the energy transition. And the rare earth deal, I think, is just really the start of that. So I think we'll have a significant opportunity in that rare earth transition, the climate energy transition for the economy. And, that will help. And, a bit of return to some corporate CapEx, some private sector investment, some private sector spending. The economy will likely grow 2 to 2.25%. And that's pretty good. It could be better, but certainly could be a lot worse. And given the uncertainty in the global economy, I think I always say this: I'd rather be in Australia than just about anywhere else.
That's good to hear. I might encourage members quickly, if they do have questions, to just perhaps pop them in the chat. It might be quicker, but I will just send through another question for Stephen now. But please do consider popping anything. Oh, there you go. Thank you very much, Isaac.
Okay. So do we have the skilled workforce for the energy transition? I don't think we do at the moment. We don't even have the skilled workforce to build enough homes and residences. So I think this is, again, another part of the productivity and immigration debate. We really need to improve our skills training, education, skills training, kids from schools, out of school, and also through the migration system. So we'll need that for construction, housing. We'll need that for the resources, the energy transition sector. We're going to need it for defence. So there's lots of areas in the economy that are going to grow, and we don't want that growth limited by the fact that we don't have enough labour to fulfil those jobs. So I think the economy is always changing. It gets very frustrating when you hear people talk about some jobs are going to be lost in the transition. Well, I think there's going to be more jobs created, and we really need to make sure we've got the skills to take the most of those opportunities. Canada and New Zealand are interesting comparisons. Interest rates went a lot higher in both Canada and New Zealand than Australia. The labour markets in both Canada and New Zealand are much weaker than our labour market. The unemployment rates moved higher, but they've also seen some pretty significant increases in house prices. New Zealand's interesting in that the city of Auckland introduced some pretty significant changes on residential construction. So basically, I believe nearly all of Auckland is allowed to have up to 3-story buildings. So planning and local councils. So that's helped with New Zealand's supply of housing. So the question on AI. So my understanding of AI has gone from about 1% to 10% in the last 6 months. And I've listened to a lot of people, including the chief economist of OpenAI, was in Australia earlier this year. I think the potential is enormous. So there's nothing in my forecast that take account of AI to answer that question specifically. But because over the next 12 to 18 months, I don't think the impact will show up in the numbers. But on a 3, 5, 10-year period, I think it will have a significant impact. I'm hoping a significantly positive impact in raising productivity, which I think will then lower inflation pressures. But we'll see over time. But definitely, I think this AI boom holds out significant amounts of promise. Do I have concerns about possible wage inflation? Yeah, I think given the inflation number that came out a week or so ago was much higher than anybody expected, and could potentially push real wages growth negative again over the next quarter or two. I would be concerned if we were to now see a coordinated campaign for another round of significant wage increases. I think that would be counterproductive for the monetary policy outlook and the economy generally. A less complex economy? Well, we're different in that we certainly have a bigger exposure to the resources sector. So our exports are predominantly resources, as many people know. I think that's been a big advantage for us because although there's some tension now in terms of their trade relationship with China, and the desire around the world to kind of decouple China from the global supply chain, it's been a huge positive to the Australian economy. I think a net positive over the last couple of decades that we've been able to export huge amounts of resources, particularly iron ore, to China. That's basically income coming into Australia. And then we have, a large domestic consumption of both goods and services, and a smaller role for the government, bigger role for the housing market. So yeah, maybe less complex, but I think it works quite well for us. And I think the outlook is relatively positive for Australia.
Sorry, Stephen. Yep.
So what was the outcome of the roundtable a couple of months ago? Well, if there was an outcome, I must have missed it. I haven't seen anything as yet, but I know the Productivity Commission are doing some work on that. So hopefully into early next year we'll see some really specific recommendations from the Productivity Commission that the government then takes up. So as I mentioned, I'm hopeful, but not particularly optimistic at this stage that we'll get a big pickup in productivity. But it's on the government's agenda. Certainly, the Prime Minister and the Treasurer are very focused on that. So I really hope they push forward.
Well, thank you very much, Stephen, for that very insightful and very thought-provoking presentation. And thank you for powering through your inability to be able to hear me, although I have heard that is actually a blessing in disguise for many people. So thank you for that. Look, it's very clear to us that 2025 has been a year of significant economic change, and your analysis here has helped us better understand the forces at play, both here in Australia and globally. Your outlook for 2026 and beyond gives us much to consider when we're thinking about what's coming next, and I know our members very much appreciate your insights. To everyone who's joined us here today and throughout the economics webinar series this year, thank you so much for your engagement and continued interest in these important conversations. We hope the series has provided valuable perspectives for you to support your work and your thinking. And on behalf of the Australian Banking Association, we wish you all the best as we head into the final months of the year and look forward to continuing this dialogue in 2026. Have a wonderful afternoon, and thank you for joining us.